I'm going to take a couple of minutes with you and just go through one of my personal favorite investing sites. Vanguard is a really large financial asset management firm. They have a lot of low cost mutual funds that are accessible at rather low fees and low minimums. So I wanted to kind of just take some time here and kind of help you with how I would navigate this site. This is a service that I personally use. I would say Vanguard is not a service that is really for stock buying and trading. It's more geared towards investors who have assets in IRAs, and other retirement platforms or their personal savings and would like to access mutual funds, which are diversified baskets of stocks and bonds and other sort of financial instruments. So, Vanguard is really known for passive management, and passive management is the management of mutual funds or ETFs that's based on indices and indices that are rule based. So, for example, the S&P 500 is the largest 500 by market capitalization companies. So, market capitalization is the stock price times the number of shares outstanding. So, there will be one of each of those largest 500 companies in the United States in the S&P 500, and that's an example of an index. And a mutual fund can be created to invest in that index, and therefore there is not any actively managed decisions that are being made by portfolio managers about things like asset allocation and taking exposures in portfolios based on the portfolio management team or the company's view on micro or macroeconomic events in the economy. So Vanguard is known for passive management. So they have a lot of different types of investment products. They have mutual funds under their umbrella, ETFs, stocks, bonds, and money market funds. Um, ETFs are exchange traded. They're pricing in real time versus a mutual fund that's pricing every day. There are some tax advantages to ETFs, which I'm not going to get into, but that's just something to be aware of. So, for example, if you wanted to take a look at Vanguard's mutual funds, you could look at all Vanguard mutual funds, and they really have quite a few. There are 377 results here for different types of mutual funds that have different index-based exposures. Some of these might also be actively managed versus passively managed. So active versus passive, meaning, based on just the index. Asset class is going to kind of tell you, is it equity? Is it stocks? Is it fixed income? Is it bonds? Is it money market, which is short term? Debt instruments, but they basically track a short-term interest rate, and then also different sector specialty funds. So you might also say, okay, well, I want to be, I want mutual funds that have less risk versus more risk. I only have $1,000 to invest versus, I have more than $50,000 that I can invest. And generally, there are some mutual funds that are only accessible when you have a certain amount of assets or money that you want to put into them. These share classes somewhat correspond to investment minimums because you pay less in fees, and then tax efficiency, so tax managed, tax exempt, or taxable. So for example, we might say, okay, well, like I want to look at, I want to go by performance, and I want to see, what is the best funds that you have on a year-to-date basis. So that's what this means here. It means what is the year-to-date return of this particular mutual fund. And then you can also see, okay, here's the 1 year return. And so this makes sense, right? Because energy and commodities have done really well in this particular year. We know that because we are all going to pay for gas every day, and gas prices are up. Our home heating costs are up. Our electricity costs are up. Commodity prices are up. We have a lot of inflation right now. So these two different asset classes are going to be well represented in terms of returns. And we can see that, their returns are sort of corresponding what we see in the bigger macro economy. We also have what's called the since inception return. And I know we talked about this a little bit in class, but what do these returns mean? So in 1 year, it means this mutual fund, if you had put in $100, you would get a 64% return on that $100 in 1 year. Here is 5-year return, and these returns here are as of the end of last month, whereas this is as of 4/30, this year's day return. So you kind of have to watch that too. But this 5-year and 10-year, these are what are called annualized returns. So every year for 5 years, this mutual fund returned 6%. It didn't return 6% last year, and then the year before, and then the year before. But if we look at the total return over 5 years and we annualize it, we get a 6% return. That allows us to compare this return to that return, and then also to the 10-year return, right? Because obviously in 10 years, we're going to have a lot more return, hopefully, than in 5 years. But we can't compare the two unless we have the annualized return, which is how much this mutual fund returned in each year for 5 years versus in each year for 10 years. So you can see kind of the 5-year return is looking a lot better than the 10-year return. Between 5 and 10 years, there must have been a downturn there. And yes, there was. Commodity prices and energy prices were lower. Since inception means when the mutual fund first opened. We can look at pricing information, right? So wow, okay, so this energy index fund, the Admiral shares, you can only actually access this fund if you have a minimum $100,000 to invest. Okay, well, that's not going to work for us. So maybe we want to look at mutual funds that have much lower minimums. And we might toggle it that way, right? So this is basically just like a giant spreadsheet that they've loaded into their site. And we can see, okay, well, this like target retirement fund, these are only $1,000 minimums. And actually, it's a really important thing to talk about here is target retirement funds. They tend to be what people will use in 401ks and IRAs. They are allocated in a way that helps make recommendations based on when you're going to need the money. So if I'm going to retire in 2040, my asset mix is going to look different than someone who's going to retire in 8 years from now versus someone who's going to retire in 20 years from now. So, or 30 years from now. So that is kind of what's going on there. In the overview, you can look by asset class, right? And then you can also toggle, in and out of the things you want versus what you don't want. I think that they have a really great, they do a really great business. This is something to be aware of. So as we're talking about things like mutual funds, what's an expense ratio? An expense ratio is actually the percentage that the mutual fund manager wants to be paid to manage the assets. So if you are invested and you have a return of 5% in 1 year, well, that mutual fund manager is going to take off 0.41% of your return for themselves. And that would be the example would be here, this global Wellesley income fund investor shares. The investor shares are the kind of shares, but basically they're going to take, 0.5%. I would say like lower cost, you will find things in the, 0.08%, less than 0.1%. That would be a low expense ratio, right? And we can also kind of look at, okay, so here's some of the really low. So institutional index, total stock market, these are really broad-based indices. And some of the higher. So in these sort of more actively managed mutual funds, and then also mutual funds where Even when they're not actively managed, sometimes pricing is just not advantageous to have such a low expense ratio in markets where pricing is less transparent, like in emerging markets or global markets. You'll oftentimes see higher expense ratios. Okay, so that's kind of how I would look at like what do they offer? They have mutual funds, ETFs, stocks. I'm not going to go into all of the different things that they offer. I just wanted to kind of show you a little bit about mutual funds and how investment management sort of like thinks about them. Okay, and so there's like different types of vehicles. Like we're talking about that in class, and we're talking about things like planning for retirement, planning for the future, and you can invest your money into an IRA before or after tax. Before is tax deductible, reduces your taxable income. 529 plans, there's small business retirement. 403B is for government employees. So let's go into this for a minute. Okay, so Vanguard is going to, kind of try to help. A brokerage account is going to be after tax. You can buy mutual funds, IRAs, traditional and Roth. Roth is an after tax versus regular IRAs before tax. If you're a business owner, you're able to actually access the same benefits that someone with a 401k plan from their business can. They create their own, and they can match their own, and so you can open your own business account, or small businesses can do so for their employees. 529 is an educational savings plan, so you can save before tax money in a tax deductible way for education. These are transfers for minors, and gifts that are limited, and then setting up things like trusts and different types of structures, legal structures, to manage assets for beneficiaries of a trust. So they sort of help you, see, how, you can invest completely on your own in these different products through these different mechanisms. A brokerage account just being a simple after-tax account. I just want to buy some mutual funds. They also provide services. So the book talks a little bit about this too, but and I posted a primer on robo investing. So that's a digital advisor. They have a digital advising service where you sort of tell them a lot of characteristics about yourself, and then they'll help manage your funds. You can hire an advisor through them. They have wealth management services depending on what your sort of situation is. So that's kind of a little bit about how I might I have an account with them, and how I might approach one of these large companies. They also have a whole lot of education that's really helpful, and I just think Vanguard is really great. I know that sort of trading stocks and cryptocurrency and all that's like pretty cool right now. But for thinking of maybe longer term and for a more diversified sort of approach, Vanguard is sort of the quintessential low-cost broker, providing these broad-based index funds that have historically returned fairly well. So I hope you enjoyed taking a look at Vanguard, and please reach out if you have any questions about any of this at all. I am more than happy to help you out.